Welcome to this session of the NC Forex Academy program. So in this particular session, I'll be showing you how to the diagrammatic representation of how the trend line works and how the trend line liquidity works in a bearish market, both in the bearish and bullish market. So I'm definitely going to show you how those trend lines actually work, because in recent terms, so based on the basic forex retail strategy, the a lot of traders act on these trend lines as solely like the belief on these trend lines as such. The market tend to manipulate them as a result of what liquidity, since market needs liquidity to make significant price movements. So as such, you will definitely see a diagrammatic representation of it. As you can see here, you probably see here, as you have the market trend to the downside as a bearish market. We have formation or forming lower lows and lower highs. We have formations. Since these formations of lower lows and lower highs, you probably see that at this level you probably have a lower low, you have a lower high, and in terms of our structure, we probably have this as a low, and price move to the downside, having impulsive and corrective waves, minor impulsive, minor corrective, minor impulsive. And as price continues to move to the downside, you see your low changes today to the next, and price continues to do what? Price continues to form series of lower lows, lower highs, lower lows, lower highs. And as the market continues to go, as we have a series of what? As we have a series of two highs being valid, two lower highs being valid, that is known, you can definitely draw your trend line. As such, you probably see that price did break this, as price did respect the third and the fourth, and as such you have what? You have traders believing a massive bearish market, and as such sell confidently. And when price had to break here, they probably have what? Based on the basic forex trading strategy, they believe the market has turned to bullish. As such, they look for opportunities, buy opportunities. But in reality of trading, you probably see the market needs liquidity, and this is just acting as a liquidity. And since we have our layer still to be taken out, acting as our first line of liquidity in smart money trading, we probably have, when including what? Structure map, when including structures. So you have this as your first line of liquidity. We have this high taken out, as you can see. So we have these trend lines. A lot of traders have been a lot of retail traders anticipating a buy, and you have that. So it doesn't mean that the trend line doesn't work. All right, it doesn't mean that it doesn't work. It is profitable. It's very profitable. That is why we had it at the beginning of the program. So when you probably have this, you see that price did respect during the third, the fourth, and as such failed here. But in reality of trading, I want you to see in a more advanced, in a different view on how the market moves. So the market moves in a wave like manner. As such, you probably see these highs. Most often these highs taken out, and price did respect them, moving to the downside. So that's it, as simple as that. You have this. So we'll definitely look at these examples, and also live examples on a live chart, to see how to see how to tackle, or how this represents, or how this looks like on a real price chart. Now, since we probably have it here, you probably see that. Let's take a diagram. Let's take a representation of candlestick chart in a bearish market. So that was a diagrammatic representation of that. So let's take a look at a candlestick representation of what? Of trendline liquidity in a bearish market. So as we have the market trending bearish, you probably see that. So you have the market trending bearish, you probably see that we have series of what? Minor impulsive, minor corrective, minor impulsive, complex corrective, the start of what? The beginning of our measure impulsive wave. So here you probably see that the market did what? Here minor impulsive, minor corrective, like the beginning of our complex wave, after this low must have been broken out. So we have what? A minor corrective, minor impulsive, minor impulsive, minor corrective, minor impulsive, minor corrective. We have a minor impulsive, minor corrective, and you probably see that we have what? Two touches right here, and we have what? This high here, and we probably have this low and this lower low. We have a lower high here. Oh, sorry, a new low. We probably have a lower high here. You probably have a lower low, lower high here. So there are probably these two highs. All right. So we probably see that during the third touch you had this, and we probably have this during the fourth touch, and you see market price did break it all the way up. So this acting as well because a lot of retail traders are anticipating sales as price did mitigate here, and when price breaks, a lot of traders are anticipating a buy opportunities based on what trend line. And as such, what you see market in reality, market just need to take out the liquidity necessary which mitigate a premium zone. And as such, since the market is bearish, the market, you always want to sell in a premium area, so or high probability area. As such, market moves well to the upside, we have what mitigate a point of interest as well, or it might take rather take out liquidity, and you see market push to the downside. That is why when taking a look at the more advanced way of analyzing the market, it gives you a better view of what the market, of what price movement is all about, and better cash better then you definitely can catch better trading opportunities. But nonetheless, like I said, we definitely have trend lines in acting as conferences in some cases where you probably have your trend line and your smart money concept aligns, and the point of interest just align with what, like for example, let's say for example here you see your point of interest aligns with the trend line, which it does what it does mitigate and acting as what one of the confluences in this area, you can definitely trade. All right, so but in reality, like I said, when trading and you probably see your trend line being broken as such, it means that price continues to go to the upside, and should you have some zones, then you should be keen and pay attention to that, and definitely wait for your lower time frame to do what, to definitely your as price mitigate your higher time frame point of interest, wait for your lower time frame point of interest to your lower time frame confirmation before considering any position. So you probably see this on the live chart. You probably have the market, you have what, your first touch, your second touch valid, and as price moves to the downside, you probably have that trend line liquidity, which you have first touch, you have the second. So you probably see that during the third mitigation, you have your confirmation, you executed here. This was a what, a reverse this was a hammer, as we probably mentioned, and you probably have what, price take out your take profit with this structural low. You probably see that this is a structural low, this is your BMS here, and this BMS was a sweep, price moved to the upside. So you probably see that this entire structure wasn't valid yet, and as such, you still had what, you still had your change of what, you still had your change of sentiment all the way up here. So as you have your change of sentiment up here, you will probably see that price did what, price did sweep this low, though it took out your take profit here based on your trend line or based on whatever structure, but nevertheless you had what, price down break here, move to the upside, and traders anticipating a buy, and you probably have what, the market did mitigated the trend line and try to push up, but instead was just what, it was just a mitigation of this zone, and price did what, price did move to the downside and made what, this trend line, this BMS here became what, a valid BMS, as price did what, as price did as price did close below here, below, as this candlestick did close below this low here, below this low. All right, because we had the first attempt here, the second attempt, and the price did close here. So you probably see that as you trade your trend line, you probably see a lot of people are anticipating buy opportunities here, but in reality of trading, the market just want to create that liquidity to move on, to continue push price downward, and as you can see, price continues to push downward and downward and downward and downward and downward. All right, so that's it. So you see trend line breaks, traders looking for buy opportunities, instead market sells off after mitigate higher time frame point of interest. Now let's take in the case of what, bullish market. Let's take a look at the diagrammatic representation of a trend line in a trend line liquidity in a bullish market. So as price in a bullish market, we have market form series of what, series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So when in terms of trend line is characteristics, when you have a valid two lows in a bullish market, you can definitely draw a trend line and wait to trade the third, fourth, and the several touches. So as a trend line, as it continues, as you continue to have multiple touches, it continues to be weaker and prone to what, and prone to break. So nevertheless, you have what, you have your structural mapping, which you had what, the advanced structure, which is the smart money concept. And taking a look at the smart money concept, you probably see that we had what, our lure as the first line of what, liquidity, when concerned what, when incorporating or when considering to trade. So you probably wait for price to take out your low before considering a trade. So right here you will definitely see that price did respected the fourth, and it did break. So, and here after this break, a lot of traders anticipating sell opportunities, and price just pushed there, actually had a sell, and probably they will definitely be anticipating what taking profits within these lows, right, and targeting these lows. As a result of that, you see price did mitigate, instead break structure, take out your liquidity, comes down, mitigate a zone, or grab some liquidity. It might be equal low liquidity, but it might be equal low and whatever liquidity below here, or mitigate a point of interest, order flow, or be an order block, and price did your lower time frame confirmation, and price did pushed, and price pushed to the upside, break your market structure. So in as much as price continues to break your market structure, then the market continues to be more valid and more bullish, as you can see here. So let's take a look at a candlestick representation of what of let's take a look at candlestick representation of a trend line liquidity in a bullish market. So as you see, as price continues to move to the upside, you probably see here forming a series of what higher highs and higher lows, new highs, new lows, and continues to move to the upside. And as you can see here, you probably have your BMS here, your structure here. Price continues to move to the upside. As you can see, you have the minor impulsive, minor corrective, minor impulsive, complex corrective. You probably have your minor impulsive, minor corrective, minor impulsive, minor corrective, minor impulsive, minor corrective, minor impulsive, and you probably have what your break of your low, and you probably see that this price here, you probably take a look at this price, and you see that you had what your complex or your measure impulsive wave. And if you take a look at this, you probably see that as price continues to move to the upside, as price did break here, you have your first touch, which is this low, and this other higher low here, and price did move up here. So you wait for the third touch, you probably see what if confirmation, you execute, and you continue to the upside. So now let's focus on here where price did take out your low, and price did break your trend line. So when price break a trend line with these retail traders, because the trend line is the most the commonly used trading strategy used by retail traders. So it is very easy to spot a trend, very easy to trade. So that is the reason why it is prone to manipulation. As such, you have what, and since they understand that, despite the fact it is profitable, since these advanced traders understand that these retail traders are susceptible to emotional trading, and as such, definitely they tend to do, or they tend to manipulate, or they tend to use a different method of riding a trade, or executing their position. So probably right here you see that as price did break here, a lot of retail traders, or a lot of traders anticipating sell opportunities. As such, you wait. Some might be waiting for what? Some might be waiting for a retest before considering a trade. Some might just enter or execute that position and start selling as a result of what? FOMO, fear of missing out. So when price did and price in reality, price just want to mitigate a zone where there is an optimal, or mitigate an optimal entry level before considering a measure by which might be influenced and price might just be definitely going down to mitigate a zone based on what it might be waiting for a good driver, a fundamental report to drive before considering driving price to the upside. So during this fundamental analysis, price might just push spikes on spikes, mitigate a zone where these traders use this as an opportunity to create liquidity, enough liquidity to definitely fill their position. And as such, you see price move reverse to that spike, and also you probably see here in this case scenario, market did break your trend line, comes down, while a lot of retail traders are trading. Some might be trading and taking profit within this low, and that's fine, but a lot of retail traders are prone to greed and all the that's emotional trading, or let's put it in quote, emotional trading. As such, you see market and price did mitigate the zone, and since price continues to move to the pure direction to which the order flow lies. Simple as that. So you see that during this level, whenever you draw a trend line, or this is how you spot the trend line liquidity. That's the reason we had a trend line liquidity, a trend line, how to draw a valid trend line during the very first start of program, so such that you understand how this is manipulated. Before moving on to what the advanced trading strategy, you better understand how this concept works first and how it is tradable before moving on to what the smart money concept. You better understand how it is being manipulated. But nevertheless, trend lines are mostly used, for you to really for it to be more accurate as you move across the time frame, the higher time frame. It becomes more valid, like the 1 day time frame, the hourly time frame, the weekly time frame, and the monthly time frame. Now this is a very good example of it. As you can see, price did what? You see price move to the upside. We have our first low, we have our second, and doing the third, you see an engulfing candle, you see your entry, and you take your profit up here. Doing the fourth touch, you see this candle, it rejects, and you probably see what doing this. So here this is a kind of a dodgy, so you wouldn't have considered, because we say two of the most commonly confirmation you need to use: an engulfing candle and a hammer or reverse hammer. So you probably have that, so you have the market go to the upside. But after this drastic shift of price to the downside, a lot of some traders implemented the NEM2 strategy, and should you have a confirmation, might just use this trend line as a confluence. So that is fine, so you definitely trade it. But now in cases where you have a trend line break whereas the structure is still bullish, right? You have a trend line break whereas the structure is still bullish. If you probably have a trend line, which I just made mention, if you have I mentioned as we definitely doing at the level of the bearish scenario, case scenarios. If you have a level where you have your point of interest aligned with what your trend line here, you probably see, and you have your alert taken out and price did mitigate there, you probably see that you have two confluence, additional confluence. This is where you can definitely add the trend line as an additional confluence to what, to that trade. So it does align with the trend line, it does align with the trend line, the 1 hour trend line, and it does do what, respect your advanced structure, your smart money concept, point of interest, and price it what, you wait for your lower time frame confirmation and price it, go to your period direction. So probably right here you see, when after the price break this trend line, you probably see this is the early time frame. You probably see a lot of traders are anticipating sales, and you did have that sell opportunity here. You have a sell here, and you definitely push to the downside. Some traders, some really smart traders, might be definitely not trading smart money concept with trend line, but having a notion about smart money, might definitely be selling here and definitely what, a short-term sell and take profit at this level of what, this point of interest right here. And you see that this is a valid entry, you execute and you get out of here. So the reason, like I said, the reason a lot of traders fail here is because they let the emotional attachment and all the like, the greed, the FOMO, and all the like, so leads them. But if you're that really cool and a professional trader, you understand that when you definitely have such opportunity, you scalp, you definitely, or short-term trade, you get out of the market, definitely align yourself with the overall market direction, because the overall market direction is bullish. So this is like a counter trade, moving to this point of interest. As such, you have what, as price did mitigate this extreme point of interest, you probably see what, because this is a change of sentiment, this low right here, and you see price did move to the upside, and it did move to the upside all the way to your BMS, and price did continue, because in as much as your structure is being is intact without leading toward a bearish market, then the market is still what, the market is definitely still bullish. But in cases where you have what, your trend line here, and you have some structures up here, value structures, and let's say for example this is your change of sentiment, price did change your sentiment, therefore overall you're definitely looking for short and sell opportunities, and since you start looking, and overall you start looking for sell opportunities, in that case you see what, as price mitigate here, break here, you have what, a retest here, then you can definitely execute, because you know your smart money is bearish, your trend line is bearish, and as such you probably see that this also add as more confluence here, because what, you probably have this as a lure here, and this is being taken out, and this acting as what, your confirmation for your Trendline liquidity. You can take that as an advantage, you definitely execute your trade, and you place your necessary stop loss, and you keep grinding the trade to the downside. So in some cases, in these cases, you probably see that this it probably works out very well, and price continues to move to the downside. But in cases where you still have your smart money concept still bullish, you have the trend line broken, you should be very keen but this might also, it doesn't mean that this all the time this point of interest is must hold. This is just giving you a signal that the market first is turning to bearish and might continue to be bearish, but in as much as you wait for your lower time frame confirmation, which you definitely have to, then you do what, you definitely, and here this trend, you definitely have what, nothing to worry about trading your smart money concept. But in cases where you needed to have considered what, a risky entry right here without lower time frame confirmation, this move here just gives you that early signal of a reversal, that a reversal here, so a reversal might be plausible. As such, you should what, you should wait for a lower time frame confirmation. So this is how you incorporate these trend line liquidities and all the like. So because they are valid, they are profitable, so it doesn't mean that in as much as they are being prone to manipulation, it doesn't mean that it is not profitable. So if you can understand how to what, how to blend this into your trading strategy, you understand better. And this is why we are here, and this is why we recommend this particular strategy to definitely take advantage of significant price movements in the market. And like I said, this trend line is acting as what, first line of liquidity, first line of signal that there might be what, a trend reversal, that a change of sentiment. And as such, you should be keen and wait for a lower time frame confirmation or more confirmation, as price did what, to be confirmed, or to be sure price is moving to the upside, as price did mitigate. To confirm this, trend line is acting as liquidity and price did move. And as you can see, you must probably be having a signal here, and price did move today to the upside, as simple as that. And still on this time frame, you can see you have what, your change of sentiment, price start forming what, higher highs, you have your the low sweep, you probably have what, mitigation of your point of interest, and price did what, did move to the upside as such. So that's that, and you see that it is nothing difficult in it. So this is how you just incorporate this. So trendline break, traders looking for sell opportunities instead, market buyers all after mitigating your high time frame point of interest. Now that's just it, that's just the end. And here you should what, after studying this session, you should be able to definitely identify valid trend lines. Therefore, if you haven't understood how to identify and trade trend lines, you should get back to the first chapter, to the first course, to definitely understand how to identify your valid trend lines. So moving on to the next, you probably have what, identify high profitability probability zones, or point of interest is below or above trend lines in both bullish and bearish market respectively. So probably in a bullish market, you probably look at what, you probably take a look at your trend lines highs, and you probably take a look at your point of interest is above your trend line. Therefore, if a point of interest is above your trend line, then you should be looking closely trend line liquidity. All right, and should your trend line be what, in a bearish market, I'm not even saying, so sorry, in a bullish market, you have what, your point of interest is below your trend line, therefore acting as what, trend line acting as liquidity. And in a bearish market, we have what, when you have your point of interest is above what, your trend line, in a bearish market, that act as what, and as that might act as liquidity. But in some cases, like I said, if you have your what, as trend line break and approaching to your point of interest, the fundamental is really not good for you to sell, then it might do what, leads to a change of sentiment. Let's say, for example, inflation data, NFP, or interest rate decision. So all that, it can result to what, it can definitely result to that. So that marks the end of this section.